that's what that's picking up. Now, there's actually a twist then to the accumulating, because how you actually put it on or how much you put on as a liability depends on whether the on whether the leave is vesting or not vesting. And what we basically mean by that is whether or not you'll get some sort of payout at the end if you have a balance sitting there. So my annual leave is vesting. If I take my annual leave, I get paid annual leave while I'm away. If I decide to leave the university, or if I get kicked out, or hopefully that doesn't happen, but if I decide to move on, then whatever my balance is at that point in time will come to me as a cash payment. If it's not vesting, I don't get that cash payment. My sick leave is not vesting. So I have at the moment 28 weeks of sick leave accrued, which is a touch over 6 months, which is kind of cool in a way, because it knows if I get, I don't want to get really sick, but if I was to get really sick, I could be off work for 6 months and my pay would just continue straight on. It wouldn't have an impact on me at all. The thing is though, if I move on from this organization, I don't get paid 6 months for that leave. Like that would just disappear. So that actually then has an impact on the liability amount that you show. And again, think about the framework definition. The framework definition is looking at the economic outflow. So if it is vesting sick leave, it doesn't matter vesting leave, it doesn't matter whether you're going to get it as leave or whether you get it as a payout. That full amount is going to leave the organization at some point. If it's not vesting, they only are on the hook for that amount of leave they expect you to take. We've already talked about non-accumulating, so we can move past that one. So an example of this, so we've got three employees working at the company. They're all on different, their leave conditions are all different. 2 are accumulating, but one's vesting, one's not vesting, and 1 is on non-accumulating leave. They all get 2 weeks of leave for the year. None of them have taken any leave this year. It's expected that A and B will take 4 days of their leave the next year. We don't really worry about C because theirs doesn't accumulate and it disappears. So the numbers that we have to look at are, and each employee receives $1,000 a week. So what's that, $200 a day. So employee A, their 10 days of sick leave, even though they're only expected to take 4 days next year, the other 6 days, even if they don't take it ever, if they leave the company, they're going to get that. So all 10 days are a liability to the organization. So they show that up as $200 of liability. The leave for employee B, because theirs is non-vesting, they only have to worry, or the organization only has to worry about the the 4 days worth of sick leave, which is $800. And so you show that up as a liability of $800. Employee C, they're not taking any leave. They don't get to roll any of that forward. There is no liability. That 10 days just disappears. So we don't have to worry about it in that situation. Profit share and bonus plans. Look, there's actually not really a lot we want to talk about in this case. The one thing I just want to make mention and just sort of draw out is we're looking at a profit share and not an ownership distribution. Because if it's an ownership distribution, you're looking at an equity effect. What it is, because it's a profit share, we're looking at an expense. So it's just a small differentiation, but it is an important thing just to pick up. Need a drink. So where are we at? Post-employment plans. Okay. So post-employment benefits, there's a range in there. And actually we've just had, and that's actually one thing I was really glad about in some respects, because we got back on Tuesday, which is what, Sunday, Monday, Tuesday, 3 days after the federal election. We were away for the 8 months of pretty much all the lead up, all the just stuff that was going on. We didn't have to pay attention to any of it, which is awesome, because it just sounded, from seeing people's comments about things, it just sounded like a pretty ugly time to be around the place. But one thing people often whinge about, people whinge about politicians all over the place. They whinge about politicians here, you go to the UK, they whinge about politicians there, they whinge about politicians in the US. That's just a fact of life. But one thing they often complain about politicians is the amount of perks that they get once they leave office. They get some pretty decent post-employment benefits. We're not going to be talking about those sort of things. What we're going to be talking about is superannuation, which is a really important thing. There is an argument, kind of a more sort of neoliberal free market argument, which is we shouldn't need to have superannuation. People can invest, let's just give everyone their own money and let them invest it themselves, and they'll do a far better job, and they know how to look. They'll be able to make the best decisions for themselves for their retirement. Now the thing is, I'm not completely sort of down the other end of the spectrum, and I'm not that government interventionist, but in the case of superannuation, I think people, if they get large sums of money up front, they can make pretty bad decisions. So I think having some money held out, yes, there have been some bad losses in the markets over the last 5 years, but it depends on the mix of assets you had in those superannuation funds. You might not have done that badly, but I think it is absolutely a better thing to have some of that money held out and just dealt with outside. But we're not talking about that sort of stuff either. What we're looking at is the accounting for these things. And I think before we even get to the accounting for these things, it's probably a good idea to actually figure out what the difference between these are. Because when we're talking about the difference between post-employment benefit plans, we're not talking about the different asset combinations you could have within a superannuation fund. We're not talking about balanced versus growth versus high growth versus sustainable versus, cash. We're not talking about those things. We're talking about an actual fundamental difference between the type of plan. So we've got a defined contribution plan on one side and a defined benefit plan on the other. Now, just as a lead-in, a defined contribution plan is now, in Australia at least, and around the world it is getting more popular as well, but the last figures I saw were probably about 70 or 80% of superannuation funds are in defined contribution plans. It's one of the biggest places where the types of plans people have their money in. It's rarely offered to people nowadays. Most, I suppose, normal companies won't offer it. It's more it's more public sector companies which have defined benefit plans. Universities do. I'm partially a member. Part of my super is in a defined benefit plan. Some older legacy companies, so Qantas has legacy defined benefit plans. CBA has legacy defined benefit plans. So they do exist, and there are still large numbers involved. But it's pretty rare nowadays to join an organisation which gives you the option to join a defined benefit plan. However, we still haven't actually talked about what a defined benefit plan is, nor have we talked about a defined contribution plan. Now, because we've only got one screen, I'm going to give you the technical definition for the moment, and then I'm going to draw it up and how this works, because the technical definition reads a little bit like gobbledygook. It's a bit wordy, but I will talk through it and then we'll draw it up and just draw up how it works, and that hopefully will make a little bit more sense. So, a defined contribution plan, and remember this is the more popular one in Australia. The entity's legal or constructive obligation is limited to the amount that it agrees to contribute to the fund. And that's important because remember, we're talking about liabilities. So the liability for the company is limited. There's a limited liability sitting there, and it's only to the amount that it agrees to put in for super. The post-employment benefit received by the employee, so that's you and me when we hit 67 years of age, well, I think some cases, limited cases 60, but say 67, is determined by the amount of money put in, so the amount of contributions, with the investment return arising from those contributions. So what that basically means is the amount of money that goes in plus how well the superannuation fund does, that's how much money you get out at the end. What that ultimately means is any risk involved falls on you. And for the portion of mine, which is a defined contribution plan, it falls on me as well. And that's what happened, unfortunately, to a lot of people 5 years ago. And when the GFC started to hit, a lot of people had their money in fairly balanced plans. Some of them had in high growth. There are big equity market components to those sort of plans. The equity market in 2007, 2008 dropped by about 50%. If you're near retirement and you've got $1 million or $2 million sitting there in super and the bottom falls out of the market and you lose half your superannuation pot, that's pretty tough to bear. And that happened to a lot of people close to retirement. So that's what it means. When the risk falls on you, when that market drops out, you're the one who cops that loss. And the company, your company, it's not their problem. their obligation is limited.